Welcome. Today let's break down 7 of Vanguard's most popular ETFs, comparing their long-term performance across 2 scenarios, a one-time lump sum investment and steady monthly contributions since inception. Did you know that with consistent investing, one of Vanguard's ETFs grew to over $1 million? To make it even more exciting, I'll guide you through 2 side-by-side back tests to show how each ETF performed against each other in real numbers since 2006. From VTI's broad market reach to VGT's explosive tech growth, every fund has a unique role. And by the end of this video, you'll be on your way to know if one of these ETFs may fit your investment goals. First up is VTI, the Vanguard Total Stock Market ETF. It gives you exposure to over 3,600 US stocks, from established giants like Apple to small but promising companies. It's about 30% tech with a balanced mix of financials and healthcare. If you had invested $10,000 back in June 2001, which was the inception of VTI, it would have grown to over $74,000 today. Now, if you had invested $500 every month in VTI, your portfolio would now be worth about $777,000. With a tiny expense ratio of 3 basis points, it's a cost-effective way to get broad market exposure and steady long-term growth. VTI is an essential component of a well-rounded portfolio. Next, let's talk about VOO, the Vanguard S&P 500 ETF. This large-cap fund tracks America's 500 largest companies, including Apple, Microsoft, Tesla, and Amazon, with tech making up about a third of the ETF. A $10,000 investment in December 2000 would now be worth $67,700. If you invested $500 monthly, you would have about $827,900. VOO is a cornerstone investment, ideal for those who want to anchor their portfolio with dependable, large cap performance. Now let's look at VUG, the Vanguard Growth ETF. This fund focuses on companies with high growth potential, such as Tesla, Nvidia, Amazon. Starting with $10,000 in February 2004, your investment would now be worth $96,700. With $500 monthly contributions, it climbs to about $781,000. Growth investing can be volatile, but for those who believe in innovation and are willing to ride the ups and downs, VUG offers exciting potential. Let's talk dividend ETFs. VIG, the Vanguard Dividend Appreciation ETF, focuses on companies with a history of growing their dividends. It's a steady, dependable choice with exposure to sectors like tech, healthcare, and financials. A $10,000 investment in May 2006 grows to over $56,000, while $500 monthly contributions reach $422,000. It's a great option if you're looking for stability and long-term wealth building through dividend growth. Next, we have another dividend ETF, VYM, the Vanguard High Dividend Yield ETF, which targets companies that consistently pay higher dividends. Financials, consumer defensive stocks, and healthcare lead the way, giving regular income over time. A $10,000 investment in December 2006 would now be worth over $44,000. Less explosive, but consistent growth with dividend emphasis. With a $500 month contribution, you're looking at $364,000 since 2006. Now, if you love tech, you'll want to hear about VGT, the Vanguard Information Technology ETF. This fund is nearly all tech giants like Apple, Microsoft, and Nvidia. A $10,000 investment in February 2004 would have grown to an impressive $142,700. And with $500 monthly contributions, listen to this, it soars to a staggering $1,179,587. That's almost $1.2 million. Tech investing isn't without risk, but for those who stick with it, the rewards can be massive. VGT is a dynamic addition, providing explosive growth opportunities to tech investors. One more ETF, VNQ, the Vanguard Real Estate ETF. It lets you invest in real estate through REITs. No property management required. Nearly all of its holdings are real estate businesses aiming for steady income A $10,000 investment in October 2004 would now be worth $44,900. Though smaller than tech, it's respectable, though slower than tech. With a $500 monthly contribution, you're looking at around $327,000, providing a steady pathway to wealth building through property exposure. VNQ is an excellent complement, diversifying your portfolio with steady income and exposure to real estate markets if that's your choice. Now let's bring it all together with two side-by-side back tests starting in May 2006. Here's how a one-time $10,000 investment would have performed across all 7 ETFs. This side-by-side backtest shows you the real trade-offs and the standout performers. VTI would have grown to $60,500, a solid broad market performer. VOO is at $62,300, slightly outpaced VTI with corporate leaders. VUG is at over $80,000, high risk, high reward growth potential. VIG, the Dividend ETF, $56,000, which is dependable growth with that dividend focus. And the other dividend-focused ETF, VYM, comes in at $44,000 with consistent income but slower capital appreciation growth. Here's the big winner, of course. VGT comes in with a $10,000 investment at $136,600 since May 2006, which we know the tech dominance has drove these returns. VNQ comes in way below the other ones at $31,400 with the steady returns with real estate. Now, tech ETFs like VGT deliver explosive results, while broad market funds like VTI and VOO excelled as foundational investments. Income-focused ETFs like VIG and VYM provided stability, and VNQ adds diversification. Now, had you invested $500 each month since 2006, VTI would come in at $468,900, consistent, reliable growth. VOO, $486,249, slightly better than VTI. VUG, strong performance for growth investors at $598,700. VIG, $422,000. VYM, $364,000. The big one, VGT, all that tech growth, $831,532. VNQ, again, underperformed the other ones at $275,500. Now, these contributions make VGT the standout for aggressive growth, while VTI and VOO delivered reliable results as core holdings. VIG, VYM served as excellent diversifiers for stability. Growth boosters like VGT and VUG provide high growth opportunities for more aggressive investors. Diversifiers like VNQ offer real estate exposure if that's what you want in your portfolio to balance some risk. The key is to align your investments with your goals. A well-rounded portfolio blends these strategies to manage risk and maximize returns. What do you think? Which ETF fits your goals best? Share your thoughts below, and don't forget to like, subscribe, and hit the notification bell for more investing insights from ETF Fundamentals. Thank you for watching, and I'll see you next time.